My name is Leis, and I'm a Senior Associate here at Clarke Hemmerling Lawyers. Many families that own an income-producing asset or business accept the advice of their accountant and establish a trust in an effort to minimise the overall taxation position of the family. So how is this type of entity treated in family law, and what happens to it when a couple separate? The most common type of trust is a discretionary trust, which can also be known as a family trust. In family law matters, commonly I see a family trust where the trustee is both spouses jointly or the trustee is a company. Of that company, both spouses are equal directors and shareholders. In other areas of law, such as tax law and estate law, the property of a trust is deemed to not legally belong to the individuals or the entity who is the trustee of the trust. This is not the case in family law. The Federal Circuit and Family Court of Australia has a wide and far-reaching discretion to pull back the curtain of business structures and uncover who really controls it. By doing so, the court determines if the property of the trust falls into the asset pool for division between the spouses or not. Where the trustees and beneficiaries of the family trust is both of the spouses together and their children, it is highly likely that both or one of the spouses has ultimate control of the trust. In that case, the property of the trust will fall squarely into the asset pool for division between them. The next step then is to establish the value of the trust. The property of a trust can be wide and varied and include assets such as the plant and equipment of a business, real estate on which a business is run from and may receive rental income or other profits, other real estate that may or may not receive rental income, shares, livestock, retail stock. Other property of the trust to also be aware of includes unpaid present entitlements, or otherwise known as UPEs, monies owed to the trust by the trustee company or by the individual trustees, monies owed to the trust by a beneficiary. There can also be income losses held over from previous years that then present a tax benefit to the trust in future years. It's important to work together with your family lawyer and your accountant to identify and value all of the assets of the trust. Once the assets of the trust are agreed and value of the trust is also agreed, the parties can then decide if they wish to sell the assets and wind up the trust, or if one party will retain it. If it's agreed that one of the spouses will keep the property held within the trust, then in their family law agreement, an adjustment of their other assets or a cash adjustment will be made to ensure a fair financial outcome for both parties. And in return, the outgoing spouse transfers their entitlement to the trust property to the spouse retaining the trust, and also resigns as a director of the trustee company or as an individual trustee, whatever the case may be. It is convenient for the transfer and resignation to occur at the end of a financial year and beginning of a new financial year, but it's not essential. It's important to work together with your accountant to ensure the optimum time and to ensure the best taxation outcome for both parties. At Clarke Hemmerling Lawyers, we can provide clear advice about your particular circumstances and advise you with respect to all aspects of your family trust and family law property issues.